The Future Homeowner Show.
Welcome to another episode of the Future Homeowner Show, brought to you by Homeowner Prep. I'm your host, Eric Helon. And if you're thinking about buying your first home, you're in the right place, because on every episode, we're going to talk about what's happening in the real estate market, what it means for you as a future homeowner, and most importantly, what you can actually do about it. We don't just talk about real estate. We talk about the money behind real estate. We talk about credit. We talk about budgeting. We talk about mortgages. We talk about wealth building. And we talk about how you can move from renting to owning your first home. So let's get into today's episode. We're going to start with the pulse of the market. This is where we discuss recent real estate headlines and break down what they actually mean for first-time home buyers. And trust me, there is a lot happening in the housing market right now. So let's get started with the pulse of the market.
Pulse of the market, what's moving now? Pulse of the market, we'll show you how. Rates in the money, inventory low, hot homes get picked before they even show. Neighborhood numbers count every trend. We reg the signs and explain it.
Let's start with a pretty big update from the National Association of Realtors. Existing home sales fell again in July. According to the latest data from the National Association of Realtors, existing home sales dropped 1.7% in July compared with June. That brings the annualized pace of existing home sales down to about 4.06 million homes. Now, you might hear that headline and think, okay, Eric, home sales are down, so what does that have to do with me? Well, it has a lot to do with you, because when fewer people are buying homes, it can change the negotiating environment. And right now we're seeing a housing market where affordability is still a major problem. The median existing home price reached $434,100 in July. That's up about 2% from a year earlier. At the same time, the average 30-year mortgage rate had climbed to 6.69%, which was the highest level in a little more than a year. So think about what we're dealing with. Home prices are still high, mortgage rates are still relatively high, and buyers are saying, I can't afford this. So they're sitting on the sidelines, and when buyers sit on the sidelines, homes can stay on the market longer. That can create opportunities for buyers who are prepared. Now, I'm not saying every seller is going to give you a huge discount. I'm not saying every market is suddenly a buyer's market, and real estate is local. What happens in San Diego can be very different from what happens in Dallas, Atlanta, Detroit, Phoenix, or Philadelphia. But the bigger message is this: you may have more negotiating opportunities than you did during the frenzy of the pandemic housing market. And that matters, because when you're a first-time buyer, you don't necessarily need to win a bidding war. You need to find the right home at the right price, with the right financing, and a payment that fits your budget. And that brings me to headline number 2. There is some good news for first-time buyers. A recent Realtor.com analysis found that the supply of starter homes has improved compared with a few years ago. There are now about 220,000 more starter homes for sale than there were 4 years ago. And starter home prices are down about 4.2% from where they were 4 years ago. Now, before you get too excited, there is a catch. There are still roughly 300,000 fewer low-cost homes available than there were in 2019. And the typical starter home still requires a much higher household income to qualify than it did several years ago. So yes, things are getting better in some areas, but better does not mean easy. And that's an important distinction. And if you're a first-time buyer, you shouldn't be looking for a perfect housing market. You should be looking for an opportunity that works for your personal situation. And here's something else I want you to understand. The market is not moving in one direction. Some areas have more inventory, some areas have less. Some sellers are offering credits to buyers, and some sellers aren't. Some markets are seeing prices soften. Other markets are still seeing prices rise. That's why you can't just watch national headlines and assume they automatically apply to you. You have to understand your local market. You have to understand your finances, and you have to understand your options. That's the pulse of the market. 2 headlines, 1 big takeaway: the housing market is changing. And for first-time buyers, that means you need to be prepared to recognize opportunity when it shows up. Now let's move into our next segment, the deep dive. And today's deep dive is a topic that I know a lot of you have questions about. Interest rates. Should you buy now? Should you wait? Are rates going to come down? And if rates do come down, should you wait until they drop before you buy? Let's talk about it.
Deep dive, go a little deeper. Deep dive, get wild. Deep dive, deep dive, deep dive, deep dive, deep dive, deep dive, deep dive.
So the first question is, why are interest rates still relatively high? Well, here's something a lot of people misunderstand. The Federal Reserve does not simply set your 30-year mortgage rate. That's not how it works. The Federal Reserve controls monetary policy and influences short-term interest rates. But mortgage rates are also influenced by inflation, bond markets, economic expectations, mortgage-backed securities, and a number of other factors. Right now, the Federal Reserve is still being cautious because inflation remains elevated. At its July meeting, the Federal Reserve kept its target federal funds rate between 3.50% and 3.75%. The Fed also said inflation remains elevated compared with its 2% long-term goal. So, what's the Fed doing? It's watching the economy, it's watching inflation, it's watching employment, and it's trying to determine when and how aggressively it can adjust interest rates without creating another inflation problem. And this is why I want you to be careful when you hear somebody say rates are definitely going down. Are they? Maybe. But nobody knows exactly when. Nobody knows exactly how far. And nobody knows exactly what will happen to mortgage rates 6 months from now. That's important because I've had conversations with future homeowners who tell me, Eric, I'm just waiting for rates to come down. And I always ask them the same question. Okay, what are you doing while you're waiting? Because that's the real question. What are you doing while you're waiting? Are you improving your credit? Are you paying down debt? Are you saving money? Are you building your emergency fund? Are you researching down payment assistance? Are you learning about FHA loans? Are you learning about conventional loans? Are you figuring out what your budget actually looks like? Or are you just watching the news every morning, hoping somebody will announce that mortgage rates have dropped? Because there's a big difference between waiting and preparing. Waiting is passive. Preparing is active, and I want you to prepare. Now, let's talk about how interest rates actually affect you. Let's say you're looking at a $400,000 home. You have some money saved, your credit is in decent shape, you have a steady job, and you found a home you really like. And then you talk to a lender and they tell you your interest rate is around 6.5%. You say, whoa, that's too high. I'm going to wait. Okay, but what exactly are you waiting for? You're waiting for rates to come down. But what happens to home prices while you're waiting? What happens to inventory? What happens to your income? What happens to your credit? What happens to competition? What happens to the down payment money you could have been saving? You have to think about the entire equation because sure, the interest rate is important, but it's not the entire equation. Let's say you have a $300,000 mortgage. At 6.5%, the principal and interest payment is roughly $1,896 a month. At 7%, it's roughly $1,996. At 7.5% is roughly $2,098. Now, those numbers don't include property taxes. They don't include homeowners insurance. They don't include mortgage insurance if you have it. And they don't include HOA dues if you're buying a property with an association. But it shows you something. Yes, interest rates matter. A higher interest rate means a higher payment. A higher payment can reduce how much home you can afford. So I'm not going to sit here and tell you that interest rates don't matter. They absolutely matter. But here's where I want you to change your thinking. Instead of asking, what's the interest rate? Ask, what's my payment? Well, that's a better question because ultimately you're not paying an interest rate. You're paying a mortgage payment, you're paying taxes, you're paying insurance, you're paying maintenance, you're paying utilities, you're paying the other costs associated with owning a home. So the question becomes, what can I comfortably afford? That's where your budget comes in. And this is why I talk about budgeting so much. Your budget is not designed to tell you that you can't buy a house. Your budget is designed to tell you what kind of house you can buy. That's a big difference. If your comfortable monthly housing budget is $2,500, then let's start there. Let's work backward. What purchase price could give you a payment around that number? What interest rate would that payment require? How much money do you need for the down payment? And how much will your taxes and insurance be? Will you have mortgage insurance? Are there HOA dues? What programs are available to you? Now you have a plan. And when you have a plan, you don't have to panic every time mortgage rates move by 0.25%. You have a target. You know your numbers, you know what you can afford, and you know what you're looking for. Now, let's talk about whether rates are actually going to come down. The honest answer is we don't know. There are forecasts that expect mortgage rates to move lower. There are also forecasts that expect rates to remain elevated for a while. And that's because the economy is complicated. Inflation can change, employment can change, economic growth can change, oil prices can change, geopolitical events can change, and all of those things can affect financial markets. So, could mortgage rates drop? Absolutely. Could they drop below 6%? It's possible. Could they stay in the 6% range for longer than people expect? Absolutely. That's why I don't want you building your entire homeownership strategy around a rate prediction, because nobody can guarantee the future. And here's another problem with trying to time the housing market. You have to be right twice. You have to be right about when to buy. And then you have to be right about when the market reaches the opportunity you're waiting for. That's hard, really hard. Instead, I want you to focus on what you can control. You can control your spending, you can control your credit habits, you can control your debt, you can control how much you save, you can control your financial education, you can control how much you understand about the home buying process. You can control when you start preparing. You cannot control the Federal Reserve, you cannot control inflation, you cannot control the bond market, and you cannot control what mortgage rates will be 6 months from now. So why spend all of your energy worrying about something you can't control? Control what you can control. And here's another thing: don't buy a house you cannot afford today because you're hoping to refinance tomorrow. I want to make that very clear. Never buy a home based on the assumption that you're going to refinance later. If rates come down later and refinancing makes financial sense, great. That's an option. But you should be able to afford the home based on the loan you're getting today. And that's how you protect yourself. And this is why I say the interest rate doesn't matter as much as you think when you have a budget and a plan. Does the rate matter? Yes, but your budget tells you what you can afford. Your credit can help determine the rate and loan options you qualify for. Your debt affects your buying power. Your income affects your buying power. Your down payment affects your financing. Your loan program affects your financing. And your overall financial plan determines whether buying a home is actually a good decision for you. That's the bigger picture. So don't let a 6 point something interest rate convince you that homeownership is impossible. And don't let somebody convince you that you need to rush into buying a home just because rates might drop. Neither extreme is good advice. You need a plan, you need information, and you need to know your numbers, because the best time to prepare to buy your first home is before you're ready to buy your first home. If you're waiting for rates to drop before you start working on your credit, you're waiting too long. If you're waiting for rates to drop before you start saving, you're waiting too long. If you're waiting for rates to drop before you learn how mortgages work, you're waiting too long. Start now, get ready now. Then when the opportunity comes, you're ready to move. Maybe rates come down, maybe they don't. Maybe home prices come down, and maybe they don't. Maybe you find your perfect starter home 6 months from now. Maybe it takes you 2 years. That's okay. Your job is not to predict the market. Your job is to prepare for it. And that brings us to our third segment, and real questions, real answers. This is where we answer the questions that real future homeowners are asking. So let's jump into it.
No more guessing, no more doubt. Real steps, real answers, that's what we're about. Real questions, real answers. Ask it plain. Real questions, real questions.
Today's first question is, Eric, how much money do I actually need to buy my first home? That's a great question. And the answer is, it depends. There is no universal number. You don't necessarily need 20% down. Let me say that again. You do not necessarily need 20% down to buy a home. And there are loan programs that allow qualified buyers to purchase with much smaller down payments. FHA financing can allow qualified buyers to put down as little as 3.5%. Some conventional loan programs can allow qualified buyers to put down as little as 3%, and eligible veterans and service members may have access to VA financing with little or no down payment. There are also down payment assistance programs available in different parts of the country, but here's what I don't want you to do. I don't want you to hear me say you only need 3% and think that's all the money you need, because buying a house involves more than the down payment. You have closing costs. You may have inspections, you may have appraisal costs, you may have prepaid taxes and insurance, you may need money for moving, and you absolutely need to think about having money left over after you close, because life doesn't stop when you buy a house. Your car can break down, your air conditioner can stop working, your child can need something unexpected, you can have an emergency. That's why I don't want you emptying your bank account just to get the keys. Your goal isn't just to become a homeowner. Your goal is to become a financially stable homeowner. So instead of asking, what's the minimum amount of money I need to buy a house? Ask, how much money do I need to buy a house and still be financially healthy after I close? That's a much better question. Now, here's question number 2. Eric, should I pay off all of my debt before I buy a house? This is another question I hear all the time. And again, the answer is it depends. You do not necessarily need to have zero debt to buy a home. In fact, most homeowners have some type of debt, and you may need lines of credit to buy. The question is whether your debt is manageable. Lenders look at your income, your debts, your credit history, your assets, and other factors when determining whether you qualify for a mortgage. So if you have student loans, a car payment, credit cards, or other debts, that doesn't automatically mean you can't buy a home. But you need to understand how that debt affects your ability to qualify. And you need to understand how it affects your monthly budget. Here's what I want you to avoid. Don't pay off a credit card and then immediately go back and run the balance back up. Don't drain your savings just to get your credit cards to zero if that leaves you with no emergency fund. And don't take on new debt right before you're trying to buy a house. And if you're serious about becoming a homeowner, you need to think strategically. Maybe you need to pay down one credit card. Maybe you need to eliminate a car payment. Maybe you need to build savings first. Maybe you need to improve your credit score. Maybe you need to do a combination of all of those things. The right strategy depends on your numbers. But the key is to have a strategy. And that's why I always tell future homeowners, don't just focus on getting approved, focus on being prepared. Because a lender might approve you for a payment that you don't actually feel comfortable making every month. And I don't want you buying a house that looks good on paper but makes you miserable financially. I want you buying a home that helps you build wealth. And that's the difference. Real estate isn't just about getting the keys. It's about what happens after you get the keys. Can you afford the payment? Can you maintain the property? Can you continue saving? Can you invest? Can you build equity? Can you eventually leverage that property to help create more wealth? That's the bigger conversation. And that's exactly why we created Homeowner Prep. We don't just want you to buy a house. We want to educate you so you understand what you're doing. We want you to understand your money. We want you to understand your credit. We want you to understand mortgages. We want you to understand the home buying process. And we want you to understand how your first home can become a foundation for generational wealth. So if you're listening to this episode and you're saying, Eric, I want to buy my first home, but I don't know where to start, we've got you. The Future Homeowner Academy is an online community designed to help aspiring first-time homeowners get educated, get prepared, and take action. You don't have to figure this out by yourself. You don't have to spend the next 3 years watching real estate videos and hoping you'll eventually understand what you're doing. You can start learning now. You can start preparing now, and you can start building your homeownership plan now. So here's what I want you to do. Go to futurehomeowneracademy.com. That's futurehomeowneracademy.com. Join the waitlist for the Future Homeowner Academy. Start your home buying journey today. Don't wait until you're ready to buy, to start preparing to buy. And don't wait for the perfect interest rate. Prepare for the right opportunity. Because here's the question I want you to ask yourself. If the right home became available tomorrow, would you be ready? Would your credit be ready? Would your savings be ready? Would your budget be ready? Would you understand the mortgage? Would you know what you can afford? Would you be ready to make an offer? If the answer is no, that's okay. But now you know what you need to work on. And that's what preparation is all about. The goal isn't perfection. The goal is progress. So keep learning, keep saving, keep improving your credit, keep paying down debt, keep building your financial foundation. Thank you for listening. And remember, you don't have to wait for the perfect market. You have to prepare for the right opportunity. I'll see you on the next episode.
The Future Homeowner Show. Yeah, we taught that first key glow. Let's go, let's go. Yeah, savings on the table, dreams in the frame. First time buyer, we know your name. Credit down payment, what's in the plan? We make it clear so you understand. Take a breath, we got you one step at a time. No pressure, just truth. Now lean in, hear the voice. voice. Your home starts here with the right choice. The Future Homeowner Show. We break it down. The Future Homeowner Show. From start to close.